New rules for credit card issuers went into effect today. The restrictions of the Card Act prohibit interest rate increases on existing balances. They also require card issuers to give 45 days notice before raising rates on future balances. What long-term impact can we expect for card issuers, not to mention for investors? Rick Shane is a senior financial analyst at Jefferies. He covers MasterCard, Visa, and Amex, among others. He's joining us today from San Francisco. Rick, thanks a lot for joining us. Obviously, a lot to talk about today with this going into effect. So talk to us about what do you think the most important regulations are as part of this new Card Act?
Sure, Julie, I think there are really three things that changed. One is the card issuers no longer have the ability to arbitrarily change rates on consumers. There are going to be a lot more restrictions on that. Second, the use of over-limit fees by the card issuers is going to be restricted to the extent that consumers are now required to opt into the programs. And then third, and again, there are a lot of different variances to these, or a lot of different nuances to the program, but one that jumps out at me is that if you have multiple lines out, and you make a minimum payment, that payment goes to paying down your highest interest rate product first, reducing your future monthly payments.
You know, Rick, I saw Elizabeth Warren on TV this weekend, the head of TARP, and she said, you know, if you figure there are 10 regulations in this Card Act, the credit card industry has already figured out how to get around 8 of them. Is that what you see happening?
Well, look, I think that this is going to change the landscape. There's no question. The card industry was operating on a set of rules that the regulators established for them. And part of those rules were a great deal of flexibility. And as a result, the card industry was very willing to provide credit not only to high-quality customers, but to riskier customers. And that's what we've seen over the last 15 years, the democratization of credit, which put credit cards in the hands of so many customers worldwide. That model doesn't necessarily work nearly as well going forward. So there are a couple ramifications. One, and to your point, the card issuers preemptively have raised rates. I have a personal card that I use that I've had for 20 years. That card has been a current payer on it for 20 straight years, and the rate on that got jacked more than 10%. The other thing is that we're going to see is the card issuers lose their ability to collect economics on some of the programs we've seen in the past. They're going to come back to us with annual fees.
Rick, could I ask, because as you mentioned, you said you had a card for 2 decades, make your payments faithfully on time, probably even above what the minimum payment is due. If your rates can get raised 10%, what does that mean for everybody else who perhaps may miss a payment or two from time to time?
Well, I think a couple things are going to happen here. I think that the card issuer's ability to sort out their customer base is going to be reduced. And so high-quality borrowers are going to pay more because if there's a little problem, I have been a good customer for a long time, and my issuer was willing to treat me as such. On the other hand, they can't predict the future, and now they have to preemptively assume that things could get worse for me.
So what the other part is they're making up, so the loyal customers, the ones paying their bills on time, they're going to make up for those folks who perhaps cannot or don't?
Well, I think it's two things. One is, yes, that they're going to have to assume that I could be a worse customer in the future and they won't be able to reprice me. But to your other point, the weaker customer, they're probably not going to be able to offer credit. You know, the old business model in a lot of ways was bring in customers at low line limits, at relatively attractive rates, see how they behave, and then adjust your relationship with them accordingly. If they're a good customer, offer them rewards, offer them higher loan limits, and if they're a weak customer, offer them higher rates and don't increase those line limits. The issuers are going to some extent, lose that flexibility going forward. And as a result, you'll see sort of a compression of the variety of programs that are offered.
Well, Rick, 2 points. First of all, though, don't the credit card companies still have really a wealth of research at their disposal in terms of how they're targeting credit cards? That still exists, doesn't it?
It does. I mean, look, you can go out and you can buy credit reports from Equifax and you can buy the credit service reports. And there is a good amount of information out there. And you can make an initial determination about the quality of an individual borrower. But where you really get to know that borrower is when you see their actual activity on a month-by-month basis. You can tell that if you have a customer who spends $500 a month and they spend it at the grocery store and the gas station, and all of a sudden they are starting to run up cash advances of hundreds of dollars every month and carry balances, that something's changed. And that's not something you can really pick up on a credit report in advance.
So, Rick, just quickly here, I mean, what's the bottom line for the credit card companies? If they're raising rates on some folks, are they going to recoup the cost of all of this?
Well, I think the way to look at this is twofold. I think one way to look at it is what it means for the consumer. I think the consumer did achieve protection here. Things like arbitrary increases in credit card rates, that was a practice that was very aggressive, and the consumer now has greater certainty if they have $5,000 worth of debt outstanding, what the rate on that's going to be. That's great. They also have greater control over their over-limit fees. That's great.
And for the credit card companies, what does it mean for profit?
I think that the credit card industry will continue to generate profits, but they're going to have to do it by not making, not offering credit to as many people, and to the customers that they do offer credit to, it's going to be more expensive. And I think the last thing is this. I think that we are very accustomed. We find pride in being offered low credit card rates and high line limits. And I think that when you get a solicitation going forward and you've been inundated for years with offers of 0-0 credit, and someone offers you 19.9, in the beginning you're going to say, gee, what's wrong with me? You're not going to respond to that.
Rick, unfortunately, we're out of time. Rick Shane of Jefferies.